Hello guys, good evening everyone. I welcome you once again to this class. I'm really happy to see you guys here, and as usual, the turn up is still low, but we can't wait no more. It's already 5 minutes past 8, and I said we have a long way to go. I need to start ASAP. Welcome you all once again. So today's class, I will want it to be interactive, by and then after everything I'm gonna say, you're gonna ask questions, you're gonna interact, you're gonna if you wanna ask questions, you just raise your hand, I'll unmute you, then you ask your questions and I'll answer them, right? So we have a long way to go, right? And it's really dedicated people that will be here very early, and I really appreciate you guys for coming very early. So without further ado, I'm gonna share my screen. We're gonna get started, right? Thank you all for coming. Let me share my screen now. I hope you guys can see my screen. So today we have a long way to go, and I'm gonna get started from where we stopped yesterday. Yesterday I briefly explained what the forex market is and how we trade um simultaneously by buying one currency and selling off another currency, right? And then through the use of broker or dealer. Right, so I've just briefly explained what it is now, and then we go continue from where we stopped. Like I said, Forex means foreign exchange market. So foreign exchange market is just, I would say it's a it is the largest financial market. Now we have the crypto markets. Now underneath the umbrella of the Forex market, we have cryptocurrency, we have commodities, we have indices, we have different asset classes, right? So commodities like we have the gold, we have the silver, we have metals, a lot of them, and also we have commodities like rice. Yeah, you can trade rice, beans, wheat on the forex market as well as the forex currency pairs. That's trading of a different country currency against another country's currency, which is the largest financial market itself, right? So moving forward, I explained this yesterday, whereby you trade currency pairs by buying of one currency and selling of the other. For example, the euro to the dollar. When you see pairs like this, when they show the euro USD, when you see pairs like this, the euro USD, right, paired against the dollar. This euro USD is what we call the base currency, right? And then this dollar here is called the quote currency, right? The quote currency or the counter currency, meaning that for me to buy euro, I'm buying euro with US dollars. That means if I want to buy 1 euro, probably I'll be buying 1 euro for probably let me say $1.9, right? So that's how buying of one currency and selling of another currency is. For example, probably if you go to, let me say, a country, imagine I'm living, let me say France, right? France spend euro, right? So let me say I'm living France, I'm going to the United States, right? So I have, let me say, about 10,000, let me say about $10,000 euros, right? So when I go to the embassy, when I drop down in the United States, I want to exchange my euro for the $2 because I can't spend euro in the United States, right? 10,000 euros. So what I'm gonna do is at the embassy, I'm gonna drop them my 10,000 euros, right? And then they're gonna exchange it for me at the exchange rate of the forex market as at that time. For instance, probably as at that time, the exchange rate for 1 euro is, let me say, $1.9. So I'll be getting about $11,900, right? As a, $11,900 for 10,000 euros. Same goes to Naira. And in this one, we have USD NGN, right? Meaning that USD is the base currency, NGN is the quote currency. Meaning that for me to get $1, and let me say currently, I think the Naira to dollar rate is about 1,600, right? So I would say for me to get $1, I need to buy $1 for 1,600 Naira, right? That means if I'm coming down to Nigeria, I have dollar at hand. I want to exchange it to Naira. I'm going to be exchanging $1 for 1,600 Naira. That's just buying of one currency and selling of the other. So what we what we how we make money is we make money through the differences of these currencies. The differences. Probably I bought dollar at this rate, I sell it at another rate, right? So moving forward, I'm going to be explaining more about how we really do this. Right now, the forex market, right, is open 24 hours for 5 days. That's Monday to Friday, exception of cryptocurrencies and volatility index. Cryptocurrencies is open 24 hours, 7 days, non-stop, all around the clock. But the major financial institutions, because Saturdays and Sundays are weekends, so most of the financial institutions are, government institutions are on holidays in the weekends, so they don't trade weekends, right? So this is GMT plus one, which is uh the that's Nigerian time, right? So the Tokyo session, that's so we call them the Asian, this Tokyo session and the Sydney session are the Asian sessions, right? So they open at exactly 1 a.m. in the on Sunday morning, right? That means Monday morning 1 a.m. They open Monday morning 1 a.m. and then they close 10 a.m. on Monday morning, right? Meaning that then the London session opens 8 a.m. in the morning. That means it interferes with the London session. When it closes 10 a.m. here, London session is already open 2 hours before Tokyo session closes, right? Whereby the London session also closes 5 p.m. every day. And then before the London session closes, the New York session have already opened at 1 p.m., right? On then probably Monday morning. And it's going to close 10 p.m. on the Monday morning. But before it closes 10 p.m., Sydney session also opens. So the most volatile time zones are the London and New York session because they are the most traded sessions. The London, which is in the UK, and the New York in the United States, they are the most traded sessions because it falls underneath a time zone whereby a lot of people are awake, right? Because the Europeans trade the financial market the most, right? So this is how the forex market and time horizon works. So round the clock from Monday to Friday, it's majorly like circulate around these time zones every day till Friday 10 p.m. right? But then the cryptocurrency market continues up until all around the clock every day. I hope you guys can hear me okay. Every day. So that is how the FX market works. And then these are the currency pairs that are most traded. We have the US dollar, and this is the symbol USD. So these are the symbols and terms you're going to be seeing on charts. You're not going to be seeing the currency name. You're going to see USD, Euro, JPY, GBP, CHF. That's the Switzerland franc, CAD, Canadian dollar, AUD, Australian dollar, NZD. These are the most traded currencies in the world, and US dollar is the most traded currency, over 85% rate, because most of all these currencies are paired against the US dollar. You see Euro USD, USD JPY, GBP USD, USD CHF, CAD USD CAD, AUD USD, NZD USD. They're all paired against dollar. So dollar is the most strongest, and we call them the major currencies. Any currency paired against the US dollar are called the major currency pairs. You have the minor, whereby you see Euro, JPY, Euro GBP, they are minor currencies. And then we also have the exotic pairs, like the CAD, CHF. They are not really traded the most because majorly gold is paired against the US dollar. So most of the exchange goes through the route of the US dollar before exchanging to another currency. So that is the reason why US dollar is mostly paired against major currencies. Even Bitcoin is paired against the US dollar. You know, even Ethereum is paired against the US dollar, as well as a lot of currencies and cryptocurrencies like that. And the second comes the euro, because euro is spent in about how many countries? All the European countries. You get France, you know, a lot of European countries, you see them spending the euro. So euro comes in next before the Japanese yen. That's the Asian. Japanese yen is the least traded. Then after them comes, other exotic pairs like the Seychelles, the CAD, the as well as AUD, right? So these are the most traded currencies. So moving forward, you're going to be seeing all these symbols on your charts. And I believe most of us have already downloaded the trading view and as well as can you guys hear me? Can you guys hear me? If you can hear me, please on the chat. Unmute it until we can.
Yeah,
Go
we can
ahead.
hear you.
All right. Thank you so much. Let me continue now. Um, this is pretty much the most traded currencies on the market. So these are the currencies we're going to be dealing with, as well as probably the cryptocurrency as well, because a lot of people love to know about the cryptocurrency market and how it works. So moving forward, I was explaining earlier how we make money, right? When I was talking about the euro to dollar. Now you can see here we have how do I make money trading forex, right? Imagine you having 10,000 euros and the exchange rate at that time, so that's euro USD. Euro USD is 1.18, right? 1.18 at that time, right? 1.18, and then you left France, went to United States, right? So you are giving them 1,000 and 10,000 euros. They will giving you $11,800 when you get to the United States. So basically, you feel like you've made more money, right? But then how you make money, we forex traders, is that when you are leaving the United States, probably when you left, the market has spiked up, and then now, as I when you came here, it was around this level whereby you sold at 1.18. Now you are not want to sell when you are leaving the United States. The same 10,000 euro you want to sell it when you are leaving the United States, because you need to get back your own currency, right? You are selling 10,000 euro at 1.25. You get that means you'll be making extra $700. This is pretty much I bought euro at this level, and then it spiked to the upside, and then the exchange rate at that time is now 1.25, and I sold the euro that I bought at that time. Now I'm making $700 increase.
Mm.
You get, so that's why you see, if you go online, you're seeing, oh, I bought Bitcoin at $30,000. Now Bitcoin is around $60,000. I've made ton of money. That's because when the market keep on spiking to the upside, the value for your currency increases, right? The value for your currency increases. So you make profit off of the exchange, the rate at that time. Do you get? So that's how we forex traders make money in the market. We make money through the exchange of the rate at which we are in the market when we saw it and when we left the market, right? So same thing goes for the Naira as well, whereby probably you have $100, you want to exchange at the rate of 1.5. You be buying $100 with 150,000 naira, right? And then probably the market is fluctuate and increased, and you are selling $100 at $160 when the market spiked to the upside. You're making 10,000 naira increase because you held the dollar, you have dollars, and then you are selling it So that's basically how we make money through the increase of each currency pairs, right? How to read an FX quote, right? That's foreign exchange quotes. Currency quote are in pairs, right? The euro is paired against the US dollar. Like I said earlier, the euro is what we call the base currency. That's, for instance, if I'm in Europe, I'm in a base country, right? It's called the base currency, and it is quoted in dollars. That means if you open your chart, you for every you look to the right hand side, you'll be seeing the chart. I don't know if I can show you. I'm coming. I don't know if I can show you my chart. Should I show my chart? Uh, Later on, I'll be showing my chart. I will show you my charts of how you can see. Let me just show you my chart, my screen. Okay, I'm on this trade now. This is U card, United States dollar, Canadian dollar, USD card, right? So I'm in profit on this trade currently like this. So this is how the forex this is how trading view looks like, right? This is how trading view looks like pretty much. So now, if you look at this right hand side here, let me show my automation. Okay, if you look at the right hand side there, if you can, all these things you are seeing here, right, is the Canadian dollar, right? So currently here, the current price here is 1.377, right? 1.377 card for $1. That means I want to buy $1, I'll be buying it at the rate of 1.377 Canadian dollar. So here is the quote section. Yeah, here is the quote section, right? And the base currency is the US dollar. The quote currency is what? The Canadian dollar. If you look at the left-hand side, right corner here, you can see United States dollar to the Canadian dollar. So the base currency is the USD and the quote is CAD. So I'm going to be buying dollar with this right-hand side here, which is the card, right? That's exactly, or if you want to sell, you'll be selling this card, right? So this is basically how it is, right? This is basically how it is. So I'll take it back to my. So that's basically how the FX chart looks like. The post currency are on the right hand side, and then the base currency is the chart you're looking at, right? So that's how it is. So when in FX in forex, when you say you want to buy a currency, which buy means what we call long. You can say, I buy this currency or I go long on this currency. And selling another currency pair means short. That means I'm selling this currency, sell or short this currency pair, right? So the beauty about forex trading is that we make profit off of in both ways, right? We can decide to sell for currency pair, and we make profit off of it. I can decide to buy currency pair and still make profit off of it, right? That's beauty about forex trading compared to investing in forex. Let me say just buying a currency pair and just keeping it, right? So that is exactly how this foreign exchange market works, right? So here you can see if the exchange rate of USD Naira is 1.5, this means that to buy the pair, I need to pay 1.15 pieces of the counter currency, which is a post currency, to buy one piece of the base currency. So, for instance, if the exchange rate, like I showed you earlier on, of the base currency is 1.5, I will need 1.5 to buy $1. That's just it. Are you getting my point? So make sure you're taking notes, right? Because we're going to be going deep little by little, and it's a lot of information. So I will advise you to, take note. As well as I'll be sharing the link and the meeting link where you can watch the recordings later on, probably tomorrow morning. You can watch this session before the next session, right? So also in forex, You have what we call the bid price, and the bid, the ask price, and the spread, right? The bid is the price at which your broker is willing to buy the base currency for you, right? The bid is the price at which your broker is willing to buy the base currency for you. That means on the chart, your broker wants to you want to click on a currency, you want to buy a currency. There's a lot of technicalities around it, right? When you click on buy, you alert your broker. Your broker will tell you, oh, you want to buy this, this way we can buy it for you. This is the price we can buy it for you. So once you see the price and you're satisfied with the price, you go on and buy that currency. And the ask price as well is the price at which your broker is willing to sell the base currency for you, right? The ask price is higher than a big price. For instance, you have, let me say, USD, Euro USD, right? Right. And the current price is at probably 1.39 per euro, right? Now, 1.39 per euro, right? The ask price in which the broker is willing to sell for it can be around 1.40, and the big price will be around 1.38, right? Because the broker makes their profit off of what we call the spread, the difference between the ask and the bid price, right? So in FX market, anytime you enter a trade, for instance, you click on a buy trade, or let me say, for instance, you click on a sell trade. Once you sell the market, and you've made your profit, and then you are willing to leave the market or exit your profit at a certain position, for you to be able to leave the market, your broker will have to buy that currency for you, right? It's technical, right? But don't get confused. All these technicalities is from the brokers, right? They are going to buy the currency and then to counter your sell trade, then give you the profit. That's how it works. So now they make that is a bid and ask price. So the difference is how they make their own money, and what we call it a spread, as well as this also we call commission. But spread is the major place where they make their profit from. And then we also have the OTC, that's over the counter charges, OTC gains, whereby they make profit off of losing traders. Don't want to get it twisted. I'm going to be talking to them, explaining how the market makers works. That's who are the market participants. I'm going to dedicate one day for that. Whereby brokers are not your friend. They are there to get you. That's why you see a lot of seminars, come and learn how to trade forex. They just give you bullshit stories about how a lot of people are making money. You can also do that. They just tell you once you get this level buy, once you get this level sell. They cook a lot of bullshit story for you, and then they will just leave it to you. And then at long run, you now lose all your money. You trade and trade. It's not working for me because they make profit off of you losing. So there's what we call counter trade, whereby when you probably enter a trade, probably say you buy, when you click on buy, your broker is not buying the currency for you. They do what we call OTC. So when they go to the counter, what happens is you click on buy, automatically at their end, it's a sell trade. They sell the trade for you, meaning that you probably go long, at their own end, they went short. Meaning that if you are losing, they are making profit off of your money, right? So you have what we call the A-class traders and have the B-class traders, right? Most losing traders are the A-class traders because they believe that you're not going to make any money from the market. You're going to lose all your funds. I'm going to be talking about market participants and how they work later in this program. So till then, I don't think I have enough money for this. That was in the past. Because in the past, I would say foreign exchange was not for you and I before it was meant for the big guys, the investment banks and exchanges and all these big even up until governments, right? So it's not for big guys like us. Up until when the internet came in and then foreign exchange went digital, that's when brokers can help by leveraging, giving you money, hoping that you're gonna make money or lose money. And then I'll talk about margin and leverage later on in the market and how brokers make money through all these stuff and how they help us also to be able to enter the market, right? They are there to help us because we don't have enough capital to enter a trade. So there's what we call margin, whereby brokers just need you to bring in 1%, of your fund to be able to enter a trade, and they cover up the 99% of the account or of the amount, right? So I've talked about margin and leverage later on in the trade. So if you say you don't have money for this, probably is in the past, thanks to what we call margin and leveraging, which brokers offer us, right? As well, demo trading as well. Demo trading is what we call demonstration trading, whereby someone opens a pretend account for the purpose of practicing the art of trading in real time. That means it's a real market environment, but it's a demonstration market environment whereby it's not you are trading a demo account to test your strategy. Is it working? Am I making profit off of this strategy? Before you now enter the market with your own hard-earned money. So what we call demo trading. So most brokers offer demo trading. So once you register with the broker, once you register with the broker, you have access to demo trading, where you trading on demo accounts. I know some of you know about demo account trading and stuff like that, but to newbies, they don't call demo trading, where you trade without risking your own hard money to know if you are really a profitable trader, right? So mistake most new traders make is they want to get everything quickly. That's the idea. All these trading educators tell us, all these brokers tell us when they come for seminars and stuff. Oh, a lot of people make money from this. Buy this account, fund this account, blah blah blah. You make money, and then when that's what we call. Oh, probably you start out, and then the first day of trading, you make a couple of bucks, and then like, wow, this is very interesting. You keep on trying and trying before you know it, you've blown your account, right? So, because emotions, there are a lot of things you need to learn when it comes to trading. What we call fundamental trading, technical trading, or sentimental trading. Sentimental trading is when you trade with your emotions. Oh, I'm losing money. How much have I lost today? Oh, it's about Jesus, I've lost 100K. Hey, what's going on? Let me add more lots. Probably if I add this one, I'm gonna make more money. Just click on buy. Oh, what's going on? Oh, margin call. The trade brokers, they take care of the market, so you have lost all the accounts. They send you a message, oh, hey, can you please try and refund your account keep to keep trading, because you've just lost all the money in your account, all this kind of thing. That's what brokers do. But we can't do without them, that's just it. So my advice to any trader is, do not trade your real money until you are a successful demo trader. Once you have back tested your strategy very well and it's working for you, when you enter the market, once you see the market, okay, what are the things I need to look out for? What are the things I need to do? And you try them, it's working for you. You do all go back testing, you test them, you use forward testing, and then you're profitable, probably 60% profitable, you're good to go. Then you can start funding your account and then you can start making money, right? So that's my advice for newbie traders. Don't worry, before you know it, you will also become profitable traders. And then you can now start taking on big lot sizes and then trade with real money and trade profitably. Trading is not a get rich quick scheme system whereby you just come into the market and then you're already making money every day. Oh, blues, make money today, thinking, wow. A lot of people, there are a lot of things that we need to watch out for. As long as in every business there are scams, right? Oh, say I bought land from a scammer and then I didn't get a land, or I bought this phone, they gave me this. There are a lot of scammers in the market. Same goes to Forex as well. A lot of scams, a lot of, there's one thing I came across while learning Forex. That was the first time I bought a course. It was I think I wasted the money because I bought from this Malaysian guy. I don't want to say the name of his for trading community. Every time he give us trading signals and then he tell you, oh, I'm making blues, blah blah. Until I get to find out, that's what we call, you have the access to buy what we call meta quotes. whereby you have the backend to MetaTrader, Twitch, the backend. You give us signal, right? You give us signal. You gave us a signal. I entered enter the trade. I was losing. I was bleeding out. He was making money. He was showing blues. What's going on? I was, can you imagine? I was surprised. Then I started me up. He said I entered late in the market. I said no. I entered immediately. You entered. What's going on? Then it was later I had to find out that okay, oh, this is what the guys got. Malaysian boys, they will trick you to buy their cars. They tell you they will post you pictures and videos of blues, meaning that once they have the MetaTrader backend, even though they are losing, they'll be showing blues. Even though they are winning, still showing blues that they are winning always. And truth be told, they are losing. They are not even trading at all. Imagine you giving out signals and you're not even trading the signals you're giving to people. Do you get? So there are a lot of scams that you have to watch out for. Not everything you see online that you believe, right? Not everything you see online that you believe. A lot of people are there to just trick you to buying their course and stuff like that. They are just out there to trick you. So you have to make sure that you go for the real knowledge, meet the mentor, get a mentor, and where you can learn. Oh, this was going on. This is where I am now. I'm on this crossroad. What's going on? Can you help me out? They give advice. You share your trading journey with them. They encourage you. They teach you. They mentor you. They guide you by the hand because they have been there before you, right? So you also need a mentor as well as you need the trading education. And you have to also be able to manage your emotions because for every mistake you make in the markets, you pay with your money. If you enter a trade and you're losing your money. You get. So mistakes, but there's no profitable trader that have not lost or they have not had a story to tell. That's just it. You have to learn. So meaning this, I want to prepare your mind that you are gonna lose money, but you still are gonna make money, a load of money, right? Like ton. I won't lie to you, but you have to prepare your mind. That's just it, right? For it to be profitable, you have to learn from mistakes, learn from mentors, learn from trading. I won't lie to you. Moving forward, time for some primary school mathematics. In the forex market, right, we have what we call pips. The smallest movement or increment of a currency. That's what we call pips. When you see on internet, you say, I just made about 100 pips, 200 pips, 500 pips in the market. Oh, I'm a genius, all these kind of things. The smallest increment in the market. For instance, for example, you have euro to dollar, and then the price changes from 1.2250 to 1.2251. The smallest increment, that means after the decimal, before decimal places, that's 2250. This last zero here, this last zero here, this last zero here, right? This last zero here, that's if it increases to one, right? That is 1 pip increase in the market. It's called pip, PIP. And then we have euro to dollar. Euro is the base, dollar is the quote. And then you have dollar to JPY, dollar is the base, JPY is the quote. And in this one, most of the minor pairs like this, US JPY, we have them as two decimal places majorly because dollar is way more expensive than JPY, right? So we have for you to buy $1, you're buying $1 for 119.80 JPY, right? So from if the increase is from 119.80 to 119.81 is 1 pip movement, the smallest increment of a currency pair. And if you look at the picture down here, you can see the base currency is the GBP, and then the quote currency is US dollar, and then the currency moved from 1.3089 to 1.3091, which is 89 to 91. That's about 0.2 pip movement. So that will call pip. So moving forward, I'll go explaining what lot sizes are, and then lot sizes is going to explain how you make money, and then you calculate the amount you've made trading all these peak counts that I'm talking about, right? Amount you've made trading all these peak counts. So, but then basically that's what we call pips. So later into the market, you see how you made a couple of 300 pips in this trade. You should know that okay, pip is the smallest movement in the market, and then you make 1, 2, 3, 100, 200 pips, 300 pips, 400 pips, 500 pips in the market. So you know that okay, pips is smallest movement. You know, do you get? That means, for instance, now no US dollar, if I have up to 10 pips, that means the market have moved from 1.2250 to 1.2260. That means for me to be able to buy euro, I need $1.2260 to buy 1 euro. Do you get? And if you move about 225 pips, that means I need 1.3350 to get 1 euro. That's just it, the peak movement of the market. I hope you are jotting things down. Please jot them down because you're going to be needing them, having knowledge and all these terminologies is needed in the market. With time, you're going to get used to it, acclimatized to it, and then you know, okay, what pips is, what's bid price, ask price, and whatnot. Right. So pip value, now this is the pip value, that's the amount you're making, right? So pip value is, how do you calculate pip value? Is the pips divided by the exchange rate as at that time, right? Which is which give us pip value. For example, for in the case of USD the exchange rate is 119.80 to get $1, right? And then the smallest movement is 0.01, right? Pip. You're going to divide 0.01 from $119.80 to get the amount we're making if market goes 1 pip in profit. If market goes 1 pip in profit, you make almost 83 cents. If market goes 1 pip in profit using the what we call, you have the extra lot size, you have the mini lot size, you have the micro lot size, you have the nano lot size. So in micro, I'm going to talk about lot sizes. So probably you're trading in a micro lot size of 0.001. That means you're making this amount for every peak movement. So if you make 2 peak movements, you add this 834 plus 834, making your price, right? So for currencies with US dollar, which is counter or put currencies, whereby it's, for example, Euro US dollar is an exchange rate of 1.2200 has a peak value of 0.00001 cent, right? So now lot sizes. With lot sizes, you're going to understand it more, right? Now, lot sizes, I would say lot is just like they work hand in hand with leverage your broker gives to you to trade, right? So fair trading pretty much revolves with the lot size you are using. A standard lot size is $100,000 worth of that currency. So for instance, probably your broker gives you a marginal leverage of, let me say, is giving you a leverage of, let me say, 1:100, which means that for every 1% of your money, you can take on a trade of $100,000, right? For instance, I have $1,000. Let me say I have $1,000. For example, probably I have $1,000, right? For example, I have $1,000, right? For If I have $1,000 in my trading account, I can take up trade up to $100,000. That's what we call lot size, right? So, for instance, if I take on a trade of one standard lot, I'll be giving my broker 1% of my account, which is $10, to be able to trade $1,000. You get, I'm locking down 10%. That will call the leverage. You get, and then I'll be able to open to trade an account worth of 100K, because normally small account sizes are not even, they're not even, you know supposed to trade. But giving leverage, you know that our brokers are giving to us, we can now take on trades that are up to the amount of 100 worth of that currency. Do you get? So for instance, now in the USD situation here, at an exchange of $119 per 119.8 JPY per dollar, and the smallest payment 0.1, right? I'm making, right? Now, this is the amount I'm making with the micro lot, right? So if I'm not calculating this amount I'll be making per one standard lot, which is $100,000 worth of that currency, I'll be making $8.34 per one pip movement. I hope you get what I'm trying to say. Because if I have $1,000 in my account, I can take up trade up to $100,000, meaning that I'll be able to make more profits faster than if I'm only trading my $1,000 account. Hope you're getting it now. So if I open up a trade of one lot, normally if I was my $1,000 account, I'll only be making just 8.34 cents per pip movement. But me, because my broker has offered me an opportunity to trade up to $1,000, to up to $100,000 worth of that currency, I'll be able to take up this kind of amount and then we make more profit. I know that these are all mathematical terminologies and you just need to know them, right? But then majorly all these things are done in the back end. So once you just click on this website, so basically the faster you make money with this kind of sizes of currency, the faster you can also lose money, right? So you just know that, okay, don't let anybody tell you, okay, trade this lot size. You have to know your risk appetite. How much how much can you know how much are you risk per trade? Do you get? How much are you willing to lose? How much are you willing to make per trade, right? So we have what we call the standard lot size, which is 1.1 lot, which is 100 units, 100,000 units of that currency. We have the mini lot, which is 0.1, which is 10,000 units of that currency. We have micro, which is 1,000 units of that currency, and we have nano. Majorly, most brokers does not use nano lot sizes, right? Mostly use a micro, mini, and standard lot size. On MetaTrader, you not see nano lot size. On trading, you not see nano lot sizes, right? So the major ones are micro, mini, and standard lot sizes that you can trade with, starting from 0.01, 0.02, 0.03, up until one lot size, 2, 50, 100 lot sizes. Based on your account size and your risk appetite, right? With time, you understand what I'm trying to say, and then get monetized with it, right? But then make sure you're jotting things down as we proceed in the meeting, right? So making profits, like I said, you buy one lot of USD CHF, that's US dollar Swiss franc, at 1.453 Swiss franc per dollar. After a while, you sell the same one lot of USD Swiss franc at 1.5, 1.4550. You've made about 20 pips from 1.4530 to 1.4550. That's when you subtract them, you see that you make about 20 pips, right? Then, if you want to know how much you made in profit, using one standard lot, what you do is a pip movement, which is on 0.0001, divided by the amount, the price at when you close the position, which is 1.4550. Then you multiply it by the one standard lot, which is $100,000 units of that currency, which gives you $6.87 per pip movement. So when you make 20 pips, you multiply the 20 pips by the amount per pip movement, and then you get the total amount you make from that trade. That's how lot size was. So it's gonna get easier going forward. Don't no cause for alarm. Don't just take it easy, but make sure you're understanding what I'm trying to say, right? So moving forward, hey, like I said, I'm gonna explain what margin is and leverage, right? Leverage and margin. So like I was saying earlier, we should traders like us, we don't have big money to trade, right? We don't have $1 million. We don't have $500,000 in our accounts. We only have $50 or $100, 200, $1,000 to trade, right? So what happens is for every account you hold, like I was saying earlier, a broker funds you with $100 in good faith. Meaning that if you're having a leverage, yeah, if you're having you don't the amount you give to the broker is so called margin. I have $100. I want to $1,000. I want to trade. I went to a broker. I deposited my $1,000, and they ask you what will be the leverage we can leverage for you. Okay, I need you to leverage me 1:100. That means for every 1% I give you, you give me 100% increase. Like for instance, now I give them $1,000. They're gonna fund me with 100K, right? 1% of the amount, right? That's what we call leverage. 1% of the amount they're gonna give me. So I give them $100, they're gonna be giving me 10K. You not see it on your screen, but then in the back end, you are having $10,000 in your trading account to trade with. So if you have a $100,000 trading account to trade with, that's what brokers front us with, so that we're able to trade alongside the big boys in the market. That's why you see, like I was saying, brokers are just the inevitable evil in the market. You can't do without them, and we need them as well as they need us as well. So margin is the amount you deposit in your trading account to trade with, while leverage is what the broker fronts you with to trade with. I get it. I'm going to be showing it to you on the MetaTrader 4, 5. How it looks like in MetaTrader 5, right? So leverage is displayed as ratio, which is whenever you're opening a brokerage account. Once you start, once you've registered, you've put in your details, they're gonna ask you leverage. What do you want? Is it 1:50, 1:100? Yeah, 1:200. Yeah, 1:500. Some brokers take it up to 1:1000, 1:2000, right? Meaning that for every 1% you deposited, they're gonna fund you with, for instance, 1:1000. If I deposit $10, they're still gonna fund me with 100K, $100,000 account. And then the one thing you should know is that the faster you make money through this leverage is faster you lose money as well. So you have to don't let anybody tell you the amount of, okay, make sure you open up a leverage 1:20, 1:50. Yes, you have to know your risk appetite and should know how much you want to make. You have to have your goal set. Okay, what you want to make on the market, what's your business in the market, and how well do you want to trade in the market, right? So margin call happens when you have lost so much and not have money for a down payment again. That means you are losing money, and then the amount you drop down goes into negative. What we call margin call happens, whereby you don't have enough margin again to deposit to be able to hold the trade. So they close out the trade, and then you lose all your money, and then you can as well just you fund the game. So you cannot have negative balance for all the market. So once you get to a particular position whereby you don't have any money in your trading account again, they close up the trade, they stop you out, and then you have to the market. So all of these things, they get easier as you go on. So now this is the interface, MetaTrader 5, right? This was about a couple of weeks ago when I was trading this account, 928. My balance at that time was $928, right? 0.98. So if you look at the top here, you can see 513.95 US dollars. That's the profit I was making at that time. How did they calculate this profit? All the positions I opened, gold, GP, BTC, they calculate all of these blues here. They calculate all of these blues here, all of these blues here. They calculate everything here, and then it sums up to 513 US dollars, right? They're not going to know how much this is equity is the amount you are having equity, but they are not, it's not yet in your account. Your profit plus your balance. Your profit here plus your balance here is what we call equity. So if you calculate this 513.95 plus 928.98 here, you get 1,442. That will call equity. And the margin I drop down for this trade is 967.14. Right? That's the amount I have. You get. So now what we call free margin. Free margin is the amount you can still take up. You get. So for instance, now probably I was in loss. Probably this is my balance, right? I was in loss, and then on this equity side, I'm already minus 900. Let me say minus 928. Do you get? You know, they fronted me with money, right? Now, yeah, I'll be having margin level of like minus 100%. That means I don't have any money again, my balance to trade with. That's what we call margin call. This amount here, when you have minus one in your equity minus 928.98, that means you don't have any money again in your account, and then you call margin call. Here, I've made profit of 500, so it has increased plus $513 of equity. And margin is the amount that you've dropped down to trade this account. And then the free margin is the amount I can still open position up to $475 in loss. Okay, that means if I continue clicking on buy on gold, I can still take up losses up to $475. That's what we call free margin that you can still trade with. I get to my point. And my margin percent is plus 149, right? So this is how the interface looks like on a phone and then on a PC, right? Now, when I was explaining buy means long. That means I went long on gold, and then sell is always red, while buy is always blue, right? So sell is always red. That means you are going short on the market, and you are selling the market, or you are going short, or buy just going long on the market, right? And then this is the product that made trading all these asset classes, right? And then this is the system view by trade. This was, I think, April, very about, yeah, April. Okay. 12/6/24. Yeah. So this was the trade I took at that time on gold. I bought gold that I went long on gold. Can you see? This way I took the trades, and then it went all to the upside, right? And then I made profit over this. This was a profit account. I was trying to pass the challenge at that time, so it's challenge account. So yeah, this is how it looks like on the system, and this is how it looks like on the phone, your smartphone. So this is how we make profits, and this is how the chart looks like when you're trading on your phone, right? I hope most of you have downloaded what's it called, the trading view, and another trader. You can set it up, just register with your Gmail, and then you have a blank screen where you can navigate. So don't worry, and because of this program, I will still explain how to, know, set up your charts, how to make it clean and neat for you to trade. Because when you get into it, you're gonna see a lot of things that you don't really necessarily need, on the chart. But then I'm going to show you how I, set up my own screen, because it's my business. So I love to make it clean as possible, right? And then one thing again you should know when choosing a broker is make sure your broker you're using is registered under proper regulation. In that there are a lot of Malaysian brokers that just come. They when you start trading. I've been in a situation whereby I set what we call take profit level and stop loss level. The market went past all these levels and didn't take me out. That means the broker was just giving issues. And sometimes there are brokers that their spread are too high. I mean, the spread, when I was even spread earlier, whereby the difference between the ask and the bid price, you get, when you even make profit, you are going to pay the spread price for them again. And then all these things constitute into you having losses on your trading account and stuff like that. So you have to know, okay, what broker should I use, right? And make sure that okay, they have 24/7 customer service by anytime you contact their customer service, they are there to respond to you, and the spread they are charging is minimal. So that means all these registered brokers that they are really used across the globe, they have really little to no spread, and then these ones are the brokers that I really encourage people to as well trade with, and their margins and the leverage. What kind of leverage they give to you? Once 100, once 200. How is it? And the currency they are available. Some brokers don't even trade cryptocurrencies. Yeah, not some brokers like that. They don't trade cryptocurrencies. So what are the currencies that they offer to trade with, and the account types offered? What's the account type they offer you to trade with? So one thing again is make sure before you start live account, them practice very well on them accounts. And my own trading broker is Xnet that I use. I've used them for quite a while. I've used a lot of brokers. I've used IC, HFM, I've used XM, I've used Xnet, OctaFX. And the one I resonate with the most is Xnet because they offer me very fast and reliable payouts. If I click on any payout, in minutes I'm getting it in my crypto account, very fast. Because I've used HFM, but I've waited up to 3-4 days before I receive payouts. I really love Xnet because they offer little spread, fast payouts, and they're reliable. So I'm going to be sharing my link to register. If you want to start using Xnet broker as well. So I think this will be stopping today. Tomorrow we're going to start with trading, the type of trading that we have, fundamental, technical, and sentimental. I'm going to be showing you, you know, you know, what trading environment you can get the fundamental news from. Usually I use Forex Factory. I'm going to show you how to set it up, and then we're going to talk about technical analysis, the chart, and then why you shouldn't be trading technical analysis. And then you need to make sure you are right. So I'm going to stop sharing my screen. And if you have questions, else, raise your hand, and then you ask my question. You can unmute to save and ask your questions. You know, anybody with questions? You can as well type in the chat section. You cannot talk. Just type. I'll look at it. Okay, please. I don't really get PEEP explanation from how to divide it by exchange rate. Okay, Melly. All right. Let me explain that again. PEEP explanation. Move back to PEEP explanation. Okay. PEEP. All right. Let me share my screen again. All right. So I was saying, PEEP is the smallest increment of a currency. Is the smallest increment. That means, I think I should use, instead of me using this chart, let me use my account, my trading account, my yeah. Let me use this instead. All right. Let me use this instead. So now, if you can see my screen, as of currently, USD card is trading at 1.377.86. If you can look at it very well, yes, this. You can look at this very well. If you can look at this section very well, I just sampled, you can see that it keeps changing. It keeps changing from 1.37779. It will soon change to 1.80. That's one peak movement. Are you getting it? is back at 1.779 again. That's one peak movement, the smallest increment of a currency, which is 0.0001 gigahertz. So the more the market goes up and comes down is the movement of the currency, peak movement. So currently, let me show you how many pips I'm already up on this chart here. On here, let me show you. Yeah, I'm already up 60 pips, right? You can see here. This is what we call 60 pips here. Look at this value here. This value here shows me 60 pips. So I'm up 60 pips on this currency here, USD card, right? So that's the smallest increment, right? So the market got to this level before, got to almost 80 pips, 79 pips rather, before it went back up 60 pips again. So the smallest increment is what we call pips, right? So depending on the lot size I take, the trade I take, let me just show you my 85. I'm bluffing. So here I'm currently up on this. This is a trading foreignness competition account. So I'm competing with some guys, in work. So here I'm already up about 2,126 dollars. And how many piece movements is this? Let me just show it here. From here to here. So here on this chart here, I already make 63 pips, right? Just like the one that I showed you on my trading view account, right? 63 pips on this one here, 63 pips. So this I'm sure now. If you can see this yellow line and this red line, the red line up here is the ask price and this yellow line is the bid price. You can see how very close it is. So the ask and the bid price here on this chart, you can see very well. It's what we call the peak movement. That is, sorry, the ask price and the bid price. So the difference between these two here is spread, whereby your broker generates from. So if I want to buy, uh, this thing is crossing each other. Let me see if I can enlarge this thing. Sure. Let me raise the ask price first. Let me remove the bid price first. So now it's already remaining ask price, right? So now this ask price is 1.37778, right? That means the broker is willing to buy this USD card for me at this amount. You can see that. Let me go to the 1 minute time frame so I see very well. You can see that it is, look at where the market is currently, but look at where the ask price is. So if I click on a buy here, this is where I'm going to buy the market from. So automatically I'll be in loss because this is where my broker wants to buy this currency for me at. You get, not where it is here. Are you getting it? So now let me now bring up my bid price. Let me see that it's gonna now separate each other. Now this is the bid price. Look at the distance now. The distance between these two here is what we call the spread. Distance between 1.3778 and 1.37773 here is the spread. This distance here, this is the broker's spread, where they make their money from. So if I want to buy this currency, I'll buy it at this level, not at the level at which the market is trading at currently. I want to sell, I'll sell at this level. So that's what we call spread, ask price and bid price. Are you getting it now? So that is that about that. And then the peak movement, you know, is the smallest increment, right? So that's basically pips and ask price and bid price. I hope you understand what I'm talking about, right? So let me stop sharing my screen again. You see, I hope you get that, Melly. Do anybody else have have a question? You can type it in the group chat or you can just unmute yourself and ask before we close for the day. And then tomorrow we're gonna continue from type of trading analysis trading. It's already 1 hour past the time. No one. Oh, okay. Timija. Do you want to say something to me, Ja? All right. If nobody has any question again, Melly, are you saying something? Okay, okay, okay. All right. Well, if nobody has any question again, we're going to end the class here. So I'll be sharing the link to the video later on. And if you want to rewatch the video about the class today, you can rewatch them for tomorrow's class as well. So I really appreciate everybody coming to the class today. And let me tell you that we are already going on. Soon we are going to start, navigating through our charts, knowing about trends, trend lines and stuff, and how to start taking trades, right? So I appreciate everybody for coming today. As well, later on, I'll be sharing to the group the PDF you need to read. So as a trader, I won't like to you read a lot. You have to read, you have to study, you have to do a lot of things, right? So don't be scared. It's all easy and with time you're gonna understand. So thank you all for coming to today's meeting. Let me do a screenshot. Thank you all for coming. See you tomorrow. Same time, 8 p.m. Let's get here. Okay, Melly said I didn't really get the free margin and margin itself. Or if I will drop the link to the video. You can watch it, as many times as possible, you know, to get really understand as well. But then I'll still be explaining more. You still understand more about margin, free margin and stuff along the line, when you get to start trading, you still understand why and how it works. So we still using the terms, and then don't worry, just you're gonna understand. You get it. Really.
Thank you.
All right. So without further ado, I'm gonna be ending the live session. Thank you so much for coming. And make sure you've downloaded your trading view and your MetaTrader 5 on your phone or your PC. You can be using them as well along the line. Thank you so much for coming today. Same time tomorrow we continue the class. Thank you so much for coming.